our amazing moderator today is going to be Kirk Emery, who is a partner at Miller Thompson. He is a business lawyer specializing in M&A, VC, sales agreements, and related matters. He advises public and private companies on technology and, of course, blockchain transactions, has advised over 150 blockchain transactions, including on staking, liquidity staking, lending, network core development, technology transfers, and so much more. So without further ado, I'm going to hand it over to you. Thank you.
Thank you very much. I would like to introduce our panelists today, and thanks everyone for being here for this exciting panel discussion. To my left is Laura Foon, and sorry, please correct it.
No worries.
Fouen. Je m'excuse.
Exactly. Perfect.
Je m'excuse. Please introduce yourself.
It was perfect. Laurent is perfect. So hi, my name is Laurent. I am a partner at Oyster, co-chair of our digital assets and blockchain team. I am very, very happy to see you all here today, and I've heard very good things from most of you. So welcome to my house, and very, very glad to have you all here. My practice is focused on securities regulation, financial institution, financial services regulation. Like many people who will understand today, I started in the TradFi space, mainly derivatives and structured notes, structured products, before joining the fintech team in 2015, and then starting to accompany our clients in their navigation of the legal and regulatory scheme in Canada of securities law and financial regulation in general when they enter the space or when they realize that they are regulated, that they should be, and we help them do that.
Next up is Dean Skirka. Please introduce yourself and tell us a little bit about yourself.
Yep. Hi guys, Dean Skirka, President and CEO of WonderFi. WonderFi is publicly traded on the TSX and own and operate two of Canada's largest crypto trading platforms, being BitBuy and CoinSquare. And we also operate a crypto payments business called SmartPay. And in addition to that, we invest in Tetra Trust, which is the DDA's company beside me.
It's a great segue to LA. Tell us about yourself and Tetra Trust.
Yeah, thanks. So we are WonderFi partly owned. So my name is Zila Vallée, second, I guess, French person on this panel. I'm the CEO of Tetra. Tetra, at some point it will change, but it's still today Canada's only regulated trust company for digital assets. So we secure, assets for accredited investors here in Canada. We're very proud of what we do. Much like some of the players on this panel, I have a TradFi background. Don't hold that against me. I spent about 16 years in traditional finance across various functions like equities, foreign exchange, asset servicing, and I used to do actually TradFi custody. So I know a little thing or two about custody. So that's me. Thanks for having me, and great turnout. And where are all the hoodies? Is my question. Too many blazers. Oh, there you go.
Short sleeve hoodie over there. And last but not least is Mark Greenberg. Tell us about yourself, Mark.
Awesome. Oh, come on. So Mark Greenberg, I'm the Managing Director for Canada as well as Global Staking here at Kraken, Canada's largest cryptocurrency employer. What else to say? Just a little bit of a TradFi background. I used to build startups for banks, trying to change them from the inside. Got sick of that over many years of trying and not really making much change. And now I'm here to help disrupt them. So let's make it happen.
Another great segue. On that note, we have 5 questions. Each question contains a bunch of concepts that we'll hopefully unpack somewhat clearly and succinctly. Starting with the first question, can you explain the concept of liquid staking and how it differs from traditional crypto staking? Now, I should preface by saying everyone will answer, but someone has to go first. And dictator that I am, I've chosen Mark.
Crap. Okay, so staking and proof of stake networks is really an alternative to proof of work, and it's a way that you can get many folks to collectively participate in the network in different ways. there's many different models of it across many different assets, and so I'm always a little bit careful to not get into too much depth because I can talk about it for Ethereum, but it's pretty different for Algorand or others. In Canada, I like to talk about staking in three parts. You've got bonded staking, which typically you keep your assets, you delegate your assets for a certain amount of time. In many of the Canadian platforms, we have something maybe it's a little bit closer to liquid staking called flex staking, where the provider itself holds some of your assets staked in a bonded way and some of your assets actually not, and gives you the right to put your assets in or out at any given point in time. And then you've got the Lido version, I guess more of liquid staking, which is an idea that you have a receipt token in exchange for your staked assets, which are staked in a giant pool inside a provider. I know lots of complexities around that model is all I'll really say. I think the other two models have clear regulatory pathway here in Canada, which is great news. Actually, Canada is one of the only countries that has a clear staking regulatory pathway, which is really neat. But it really doesn't include liquid staking in any real way, and have to be really careful around it.
Thank you, Mark. Maybe Dean, expound on some basics of staking.
Yep, absolutely. I guess from our perspective with BitBuy in particular, which has staking on it today, we think of it as a way to provide additional products and services to our clients in a regulatory compliant environment. Most of our clients prior to would likely withdraw their Ethereum or their Cosmos or whatever it would be to offshore unregulated platforms, and I don't think regulators or platforms like ours can ignore the patterns that we're seeing within the industry, and it's on us to work together to find the ways to bridge the gap and make sure that some of these assets can stay in Canada on regulated platforms like ours. And we look at it as a phased approach where we work with regulators to find a common understanding on minimum viable product, I guess, in effect, something that we can roll out into the market, and then continue to assess and evaluate ways in which we can expand on that. To Mark's point, liquid staking may be a bit far out for that conversation today, but certainly look to ways in which we can evolve that product and continue to grow it and provide Canadians with the services that they otherwise would use on unregulated international platforms, which time and time again we are reminded about the risks associated in doing so.
Thank you, Dean. Would you like to talk about some of those risks, or Laura?
Well, I just wanted to make sure we mention a few things, because basically liquid staking is there in many different shapes or forms, as we will go through this panel, but the goal and what we will want to cover are what are ways to solve the main issues with staking, and it being mainly the lockup when you first stake your assets and you have to wait for a little while before they can start earning. Then when you unbound, there is also some time. So there is it is this aspect, like the time aspect to earning once you stake and when you want to stop staking your assets, that we're trying to solve here, and we will address different ways of solving that. And I just want to make sure that we put on the table what we're talking about here for everyone.
The hardcore basics.
And I just, if I may too, it's important that people understand, I think there's a lot of people that are native in this room, but it's a very important part of the ecosystem. Staking, obviously you can go on the platforms like BitBuy and get an incredible yield, or Kraken, and it's great and gives you your assets are working for you, but the assets are really there to support the network, right? When you're staking, you're confirming the network. So as much as the previous panel talks about mining and why that's important to Bitcoin, staking is very important to a lot of layer ones, including Ethereum and some of the others. So it's more than just a financial product. It is a very important part of the ecosystem, and that's why I think the regulators have done a good job in Canada understanding that we need to be doing this to help grow the ecosystem.
And some of us, like myself, would argue that it's not a financial product at all, that really staking is a process whereby you do work in exchange for rewards or income from the network. The work is you validate transactions before they're sort of appended to the network. So to try to pull all this together, all these answers together, staking, I think, is when a token holder pledges their token as collateral to the network, they bond it to a validator node, and that validator node, if it's selected from the active set of validators to validate transactions, then it'll validate the transactions and either do it correctly or incorrectly. If they do it incorrectly, the network might slash your tokens and take a small amount of the principal, and that's the penalty for doing it incorrectly, intentionally or unintentionally. And if you do it correctly, then you get paid a little reward. The reward consists in the native token of the network. So that's pure staking. As we discussed, there's the issue of when you pledge those tokens, they're locked up. There's a bonding period. As we discussed, there are a variety of bonding periods. Every network's different. They generally range from 0 days to about 28 days. Polkadot, DOT is like a 28-day unbonding period, so it can take 28 days to initiate and to effect a withdrawal. So that's where liquid staking comes in. When you stake your tokens, you get something back that is liquid and tradable. You can use it as collateral for something else. You can lend it. It's kind of like when you take your jacket at a concert and give it to a coat check. They give you back a little piece of paper or a token with a number on it that's associated with your jacket, and then when you go get your jacket back, you hand it in and you do the exchange, and that's sort of what liquid staking is. So it adds liquidity to the process to solve the problem of the bonding period and the illiquidity associated with staking in general, which isn't a problem for hodlers. Didier's comment was a great segue to question 2, which was question 4 on the list, but we're jumping around. That's me. I reorganized the question order. Panelists. Question 2: why is staking an important part of the crypto ecosystem? Why is it important to allow crypto investors to participate? Maybe Dean can take a swing at this one.
I'll do my best. Yeah, I think it's important, for many reasons. I kind of touched on it in my first response, but this is something that crypto participants are actively engaging in today. Think about, hodlers, like you mentioned, long-term holders. If there's an avenue for them to earn passive yield, I'll call it, for lack of a better phrase, on
Rewards.
Yeah.
Sorry, yes, rewards. Yes, I know there's some regulators in here too, so I'll retract. Look, I think it's important, and it's a fundamental component of the industry and the ecosystem, and it's important for us to be able to at least have a path to offer these products and services. To your point, if I'm using my own MetaMask wallet and staking in Ethereum directly to a Lido Finance, maybe there's an argument that that's outside of a regulatory purview, perhaps today. But platforms like ours that are based in Canada, that are under jurisdiction of the OSC, the CSA, and CIRO, can't really operate with that understanding. And so for us, again, working with regulators to say, hey, this is a core component of the ecosystem. This is something that Canadians are going to continue to use, whether it's onshore or offshore. You think about the framework that was put in place around trading platforms like ours. It covered simply the buying and selling of digital assets. The industry is much larger than that and obviously evolves quite quickly. And it's really important that the regulators appreciate that and understand that for platforms like ours to continue to be successful and for us to continue to protect Canadian participants, products and services like these need to exist in the Canadian market. And so I think of it from that lens primarily. I know from DDA's point of view, which is certainly valid, staking in itself, if you step back from an infrastructure perspective, certainly is a meaningful innovation in the industry, provides meaningful differences to proof of work and provides certain benefits that maybe proof of work can't compete with, certainly from an environmental perspective at least. Certainly there's a lot of benefits in my view with the staking product itself. And from a Canadian lens, we just look at it as an important piece of infrastructure in the broader ecosystem that Canadians are looking to interact with.
It's worth pointing out that staking makes most proof of stake networks inflationary in some respect. And if you don't participate in staking, you're actually potentially losing value. And so I often like to reframe the question a little bit, which for regulators is always like, why should we allow staking? But the real question is, what are the negatives attached to not allowing staking to network stability, but also to Canadians and clients around the world? And so the other piece to say is, it's a relatively, if done right, when done right, staking is a relatively low risk opportunity to get rewards, to help the network, and to help yourself. And I think all those things together really make it a no-brainer, which is why I'm so thankful that I think the CSA and CIRO have been really thinking about how we can offer it here in Canada and how we can get some of the benefits of the flexibility that folks want. They may not want to bond for 21 days or 28 days, depending on the network, or 45 days for Ethereum at some point. And I think there are ways to still create some of the benefits without that in play, without necessarily requiring it in place. So.
And sort of as a subset of this question, Laura, could you say what would a proof of stake network look like without staking?
Me?
Yeah.
I have no idea. How would you do it without staking?
Case in point. You couldn't have one. It's an essential.
Yeah.
That's like, it was a rhetorical question.
I know.
Why is staking? And the question is, why is staking an important part of the crypto ecosystem? It provides security to the network. Without it, the networks would be less secure. It'd be less reliable, and it could harm token holders. It could harm the public.
Yeah, and I think to a point that has been made before, but that is important to take into account, is that we are still in a market that is global. So it is important to allow Canadians to access staking.
Totally agree. Didier, do you have anything to add?
No, I think the panel did a great job on this one. We can move on.
Agreed. Number 3, how does the Canadian regulatory regime look at staking? And part 2, at liquid staking. I think I know who we should start with.
Hello. So there are 2 parts to answer that question, and I think that there is the generic part of how it's looked at, and there is what does exist today as regulated, like Mark has alluded to. And today in Canada, the CSA has approved investment funds that stake the assets under management of the fund, so that the investors in the fund can actually benefit from the yield generated from, not the yield, the rewards generated from that. And we also have CTPs that have been approved to provide staking services for their users. And to put that into perspective of what all that means is, the CSA has always been clear that their position is that staking may involve the issuance of securities or derivatives. And you've all heard, everyone being in the crypto world, you've heard the words securities, investment contracts forever, right? Since you've started getting involved in the space. And when we talk about staking, you need to take a step back and look at the contractual arrangement that implies. What does that mean exactly? So, and when you look at liquid staking, even more so. So we've described to you that in its most simple form, and really let's simplify things the most we can. If we're staking our assets and getting back a liquid staked token in exchange, and after a certain period of time we want to get back our staked assets with the rewards that come with it, that means that at a certain point in time you need to calculate exactly how much rewards are being given back in exchange of that liquid staked assets. It's not one-to-one, right? And there are many different ways of doing this, and each person that does liquid staking or flex staking does and calculate these in many different ways. But you need to look at it with the lens of, does this fall under our famous definition of securities that we have used from the beginning? And that's what the CSA will do, and that's the work that is being done today. I will not come to any conclusion with this, but my point is, do pay very careful attention to the valuation behind, to the way it is being done, and what it implies. when we do that. And just to take a step back on this, when you look at that contractual arrangement, or when you look at the smart contract, or the way the valuation will be done when you stake and when you use liquid staking, remember that what the CSA has done in Canada that has not been done in other countries is really clarify that it is not the instrument, necessarily the instrument that needs to be a security, the famous investment contract. It can be the arrangement between the parties. And that's what they've been very clear on, and they said, and that is why our CDPs are regulated and registered. It is when the contractual arrangement is deemed by our regulators to be an investment contract. So this is just a few red flags when you look at staking and liquid staking and knowing our regulators' position. And I'm sure the three of you will have a lot to say about all of that.
Yeah. I mean, I would just add to, the CSA obviously has a framework, but it was utilized to create a framework for infrastructure providers like Tetra as well, right? So Tetra was able to secure essentially staking approval from our regulator earlier in the year, which essentially is a path for us to offer staking to our custody clients. Now, it's very clear that we do not stake ourselves, or we don't actually do the staking activity, but we are able to essentially offer that product to our client through partners. And when you look at liquid staking, I mean, one of the issues that I think personally is if you look at the framework that the CSA has put forward, or that our regulator has put forward from an infrastructure provider, there's a lot of requirements around who you're doing business with from the staking perspective, right? Like, who's your staking provider, what's their track record, all sorts of metrics and reporting that you need to pull out, including, their balance sheet, and et cetera. Very hard to do with LIGO, right? Very hard to do with, any kind of DeFi product, actually, I should say, right? So this goes way beyond staking in my view. It's probably applicable to a lot of DeFi. If you think of the framework, they're like, know who you're doing business with, know your business. And it's hard on the liquid side to really know the counterparty and get the information you need, and you do the due diligence as a provider. So to me, that's probably the main issue with liquid staking right now, based on the current regulatory framework. Not saying the framework is wrong, just saying like it's just hard to do what we need to do to get into like liquid staking.
Laura, it points out, I guess, the interesting part of our Canadian regulatory regime, but also potentially so this idea of a crypto contract, which exists here in Canada, is super unique. It's an interesting way to regulate CTPs, crypto trading platforms, and not regulate the underlying assets. And so it's a nice compromise to use existing rules to create what on the whole is a pretty solid regime. The challenge of it, though, is starting to become more apparent as more built for purpose laws are being put in place in other markets like Europe that encompass the whole ecosystem and provide rules and approaches for liquid staking providers, for crypto trading platforms, for direct delivery. And I think more and more we're going to see. The weird thing is, and we've been talking a lot about this with the CSA, is because we only regulate a small slice of the whole ecosystem here in Canada, weirdly, the more we regulate it, the more we're going to start to see folks go to the unregulated pieces, which are fully legal in Canada, such as direct delivery. And we need to make sure that we balance those pieces together. We want folks to have as much protection as possible. We don't want, but if we go over the top on protection, on unnecessary paperwork style protections, lots of check boxes and things, then people start moving across to other types of platforms that don't have any protections attached to them necessarily, or fewer at least.
Dean, maybe if you could weigh in on this question from the perspective of a market participant that's seeking to comply and complying with the rules.
Yeah, absolutely. Yeah, and the question was, how should regulators be looking at staking or liquid staking? I don't really think that's my job per se to tell them how to be thinking about it, but I think my job is to make sure they are thinking about it and actually looking at it and taking it seriously. And I think about BitBuy, I think, is coming up today or tomorrow on the 1 year anniversary of receiving its staking license. the 6 to 9 months prior when we first submitted our application, I don't know if anyone there had a clue what we were talking about, or if there was any interest at all to even respond, but there was a process that we undertook. We brought in the partners that we had recommended we work with, and through a 6 to 9 month process of educating and collaborating and understanding their vantage point and ours, we were able to come through with an order that would allow BitBuy to offer staking to retail participants. And so I guess sort of repetitive, but I think for us it's important to understand the broader ecosystem. Like to Mark's point, there's a very narrow component of it that is regulated in Canada. They've done a really good job at regulating that component, but you think about DeFi, you think about NFTs, you think about staking, it's a much broader ecosystem than simply buying or selling. And we recognize that naturally, being as close to it as we are, and it's not as straightforward for regulators to understand it. Obviously, they're regulating the traditional financial system as well, which probably takes up significantly more of their time than we'd like, but that's just the reality. And so, really it has to be collaborative, and we have to really, I think, push the conversation forward in terms of, hey, this is why staking is really important. We really need this product on our platform. Here's how we believe we can offer it within a compliant framework that protects clients at the same time as promotes innovation in the Canadian market. And we will definitely look to be doing that with future products and services as well. And like I said, I think it's important that they are looking at it, developing an understanding of how things work today, how things could work in a regulatory environment, and collaborate with the industry as they have with staking to actually push innovation and capture as much of the ecosystem as we can within Canada.
That's a great way of summing it up. So if liquid staking has some potential challenges in Canada today, are there alternatives out there for token holders who want to stake, don't want a liquidity problem? What are some of those alternatives available in Canada today, perhaps more easily? Mark, do you want to kick it off on that one?
Yeah, and I actually had already started on the flex staking approach. It has, you still lock up your assets to some extent, so there's pros and cons of that piece. Someone also mentioned 3IQ's ETF now, and that's another approach potentially. Sorry, what are you laughing at? I'm shilling others. No, it's. I think there's some interesting pieces around on the ETF side as well, but. And then there's also some interesting non-custodial approaches as well, through Tetra, through others in the US and beyond, that I think could also help in that regard. So lots of options. I think for the average person, I think it's a much safer regulatory bet in Canada at this point to participate in a flex staking product or an ETF than it is in something like Lido.
Diddy, can you talk about some of those alternative
Yeah,
things you offer?
maybe I can expand on the ETF side too. So we helped launch essentially, North America's first staked ETF in our partnership with 3IQ and Coinbase, I want to say about 6 weeks ago. That was a lot of work. There was a lot, again, like the regulators were at the table for those discussions for quite a long time. They were able to get there. It is a nice way for people that maybe don't want to own the asset themselves. I don't really understand why people would do that, but for those that don't want to own the asset and want exposure to ETH and staked ETH, you can now do it via the 3IQ closed-end funds or ETF. Obviously, the ETFs are kind of very redeemable, right? It's important to understand that there are thresholds around staking on these products. All of that information is available publicly, so you can go source it. So it's not a 100% staked vehicle, but you are getting exposure to those rewards. As part of that vehicle, there's also the closed-end funds, but obviously there's not liquidity around closed-end funds. So I think some of the products are being developed. The safest way to stake is probably to buy 32 ETH if you want to do it on ETH and stake it yourself. But I understand not everybody wants to commit that amount of capital, to that specific asset, right? So, but we will see more. Lido, I think the original title of the panel was Lido. Lido is somewhat concerning, right? I looked it up this morning. They have like 30-something% now of liquid tokens, right? It's a pretty big amount. Obviously, there's companies that are trying to come out, like companies like Alluvial come out and compete a little bit against Lido. They're trying to build a platform. Everybody's trying to do their own liquid token. It seems to be the flavor of the day right now. So we don't really know how that will evolve. But I'm careful not to use the word safer. There are other ways to get exposure to staking products, specifically Ethereum today. Through funds, through ETFs. And there are some in Europe as well, and I believe Japan launched about a month ago or so as well. So they're starting to roll out globally.
Dean, what are you seeing from your company's perspective on alternatives?
Yeah, I mean, I think for most people in the room and most participants in Canada in general, they're generally more conservative and for a large extent less sophisticated with respect to non-custodial wallets and stuff to that effect. So I would say from a Canadian perspective, it'd be important to understand which regulated platforms are offering staking, and if you are looking to get exposure to staking, I would start there and start to build up an understanding of how those platforms work and start to understand from there the differences between liquid staking, the different providers that exist for those products. And I think education is key. I wouldn't recommend jumping into liquid staking without understanding the risks and actually understanding how those platforms operate, where they operate. And I think that's really why it's important for platforms like BitBuy and Kraken to have these offerings available for Canadians, obviously to engage with these offerings in a regulatory compliant manner, but at the same time build up their understanding of how these products actually work before exploring alternatives like liquid staking.
And Laura, do you have any comments on this as well?
Well, I don't want to go to what would be the next question, but I don't think we have much time left. But so I think that this was a good segue to something I did want to talk about,
Please do.
which and I've alluded to it in my earlier answer. It's really when looking at liquid staking, to me, and maybe it's because I'm a lawyer, but one of the main things to look at is the valuation. Is really how the different, because people will stake at different point in time, but stake with the same protocols eventually, and then you will redeem, right? So how is the calculation of the valuation ultimately done? What is the relationship here? How is the lockup period being dealt with, and then the unbundling period being dealt with? Before considering any type of liquid staking, I would really dive very deep into how this is being done, the way you're looking at doing it.
Laura, it's a good reminder. I think even with centralized platforms, you should do the same thing. Fees are dramatically different across the industry in Canada and beyond. Some are like 3 or 4 times higher than ours, which is a lot. The rates are different, obviously, if you choose flexible versus bonded, and there's different approaches to folks depending on how easily you need the money back. You need your crypto assets back. You might want to choose a bonded product to have higher returns. And the way folks pay returns is a little bit different. Some are smoothing, some are actually paying fixed amounts and then taking the difference. So really, even among regulated platforms, there's actually a lot of different ways that staking is offered out to folks, and it is on folks to do their homework. And I actually hope over time we'll add more transparency to some of those things right into the regulatory regime.
So just to clarify, this question follows from the previous question, and this one is, what are the risks associated with flexible staking products, and how do they compare to traditional staking risks? So we've looked at basically ratios for being sure you get back what you're supposed to. Any other risk, Didier? Do you see anything?
I feel like Mark should start that one. Sorry, I said I didn't get it with, but he's the flex staking pro.
He's a guru.
Yeah, so I guess flex staking is this idea that we keep some of your assets not staked and some of your assets staked. You get a lower return, but you can have them back when you want. Getting those ratios right is hard, and it's never going to be perfect. And so in those situations where a provider has gotten that ratio a little bit wrong, what it means is that you may not be able to get your assets back as quickly as you had hoped. So even though it says flexible and it talks about the idea that you can have it back right away, that's not always going to be the case. different providers handle it in different ways. Actually, Kraken predominantly handles it by using corporate inventory and actually fixing it from internal inventory, which is allowed through the regime. But there's different styles of approach to that depending on who you're working with. It should, with the right risk management practices, happen very rarely, but it's crypto and tail events happen maybe more often than we'd like, and so you should be thinking about them and understanding what would happen if I can't have this back as quickly as I need it.
Didier, do you want to jump in from?
Yeah, I mean, I don't know what I could add outside of maybe I agree, and you know, it is the same framework that was applied as well. I'm a custodian, I'm talking mostly about ETFs here, but like in the ETF framework, right? Like the reason why they're not allowing ETFs to stake, upwards of 50% is for these tail event risks, right? I mean, at the end of the day, who knows what will happen to network congestions, if everybody's trying to get out at the same time. You need to be able to give your clients liquidity pretty quickly, daily on the ETF side. And actually, I do commend, like the 50% is not arbitrary, like maybe not everybody would know this, but it comes from securities lending. If you're, essentially an asset manager and you're doing securities lending, there is a 50% threshold. And when you think about it in securities, you're getting your assets T+1, maybe T+2 if your settlement fails, max, right? With something like, Ether, like you really don't know when you're going to get the asset back, depending on what's happening on the network. So those ratios are hard to do. I know the regulators are looking at them and they're very close to it, and I think it's the right thing. But you are always kind of taking a risk, like that's just the nature of it.
And offset by hopefully the benefit of liquidity. Dean, you want to opine on this one?
Yeah, sure. I'd just say from a Canadian lens, you look at flex staking products compared to traditional staking products or compared to liquid staking products, again, just understanding the counterparties, the platforms that are offering these services. And, with respect to something like liquid staking, there are far more unknowns about the entities, the regulation behind those entities, governing those entities. And, everyone here in Canada is fortunate to be in a jurisdiction that actually has clear and concise regulation for trading and now staking. And I would encourage you guys to start with those platforms and better your understanding from there of what else is out there.
Awesome. So let's open it up. Probably go for like 2 questions. Anybody have a question? Okay.
Great panel, guys. So my question is, much like stable coins, liquid staking tokens have an inherent risk of depegging from the value of ETH, right? So, and Didier, you actually touched on this. Given that Lido's dominance now is over 30%, they account for, 33% of all staked Ether on the network. Do you see Lido as an existential threat to the Ethereum ecosystem? And do you see some competitors like Rocket Pool and Alluvial coming in and taking some market share away?
Can I plead a fifth and not answer? I mean, listen, competition is inevitable, right? Like if somebody owns that much market share, typically somebody will try to come and take it. Alluvial has hired a lot of great people. I know they have a lot of great partners behind them. I know they're trying to come for this. I think the industry, unfortunately, is kind of doing itself a little bit of a disfavor by all trying to launch their own tokens. I alluded to that before. We should ask the pros here, but there's no way these guys are going to list CBETH on their platform, right? So why wouldn't you just put that firepower into an organism that can be maybe a little bit more neutral and go help protect the network in a different way? So I do think it will happen. When and how, I don't know. But yeah, I'm just gonna speak for myself here. I have a limited amount of Lido tokens, very much by design, right? And everybody should consider that. I'd much rather leave it on these platforms, even though the fees are not always the same, than leave it on Lido, because quite frankly, I don't know anything about the organization. Right. So yes, to answer your question, but it's a little bit tricky.
we sadly just, I think actually today, decided we'll be delisting our wrapped ETH and that Bitcoin for similar reasons. Yeah, I'll leave it there. I think we're going to continue to see liquid staking platforms struggle with some of the regulatory regimes around the world.
I'll save time for one more question. Yeah.
Thanks everyone for the panel. My name is Dave Liang, and I have a background working on sort of proof of work mining pools, like Bitcoin mining pool, as well as some experience on the proof of stake side as well for sort of layer ones. We've seen on the mining pool side that Bitcoin mining is kind of ruthless, sort of a commoditized race to the bottom in terms of fees. You could sort of look at staking very much the same way as sort of a commoditized, race to the bottom service. So in terms of like value differentiation for customers or for anyone that you'd approach, what are ways that you're looking to either build out your products or services that really differentiate these services, since they can be very similar, at least on a surface level and maybe fundamentally at a protocol level in terms of rewards?
I could weigh in on that one a little bit and welcome panelists too as well. If you're picking a staking provider, look, putting aside price, which is huge, you look at slashing history. Have they been slashed? If so, how often? You look at their uptime. You can go on like ETHScan or Block Explorers and look at the different validator node companies and see what their uptime is as well. So those are two great ways to evaluate sort of the core essences of a staking provider. The uptime one is important because if they're down, they're not generating rewards, so you suffer an opportunity cost. And obviously slashing, if your principal's getting slashed, you're losing that way too. Other than that, I can think of just ease of use, frankly. And if it's integrated with your wallet or your cold or hot wallet, whatever you use.
I hope we'll see more Canadians in 2024. I believe we'll see more Canadians dive deeper into the prices they're paying for crypto and staking and otherwise, and that we will see that sophistication increase, and I hope we'll see the prices start to drop. For Kraken, be big, be cheap, I think would be pretty much the strategy on staking. Let's make sure we and then offer things folks want at a slight premium, like flex staking and otherwise. But at this point, especially in Canada, I'm surprised by the lack of price consciousness among many folks using many platforms at the moment. And I continue to push folks to just become more sophisticated and to see more of that race to the bottom on pricing, which is a good thing for, maybe not a good thing for me at Kraken, but a good thing for us as an industry.
I was just going to say, like, this is very much a personal opinion, but I think you are correct on some of the commentary you're saying around rewards and whatnot. You've certainly seen it, right, in the last couple of months on Ethereum, for example. But if you're buying Ethereum to earn like 2, 3, 4, 5% of reward, like, why are you bothering, right? Like, there's better ways to earn on other things, including cash right now, given what interest rates are. Like, the reality is, for myself, like, I believe in the ecosystem, I believe in the technology, staking is a way of essentially helping secure the network. Like, that is why I'm doing it, not so much for the reward incentive, right? So I would just maybe flip the question a little bit. Like, I don't really care about the economics that much. You're doing it because you're providing a service back to the network, the ecosystem. And, I think everybody wants to see like some of these tokens go to the moon. So you're not really doing it for, the couple percentage points of rewards you're getting. Like, that's just a very personal opinion, but, I don't I wouldn't care so much. And I think majority of players in the ecosystem as well would probably take the same view. Like this isn't like, oh, is this competing with a GIC product? This is more like, I care about this asset. I think this technology is going to change the world, and I want to help secure the network.
Wait, but the one big difference is your assets are held one-to-one in trust for you and not at a bank, and 10% of it being held while the best being loaned out to others, and they're making lots of money off of it. So I would just raise that as an important difference between cash and
Awesome. Just give them a round of applause, guys. Thank you so much for being here.